Hello everyone. Now we are entering into the week 9 and the topic is Markowitz portfolio theory. So before elaborating this particular theory, let me take into the contents of this particular chapter that we are talking about the background and then MPT theory, its assumption, the concept of diversification, principles of diversification, superfluous diversification, problems of superfluous diversification and types of diversification and the limitations. So, before starting or dwelling deeper into the Markowitz portfolio theory, let me take you to the concept which we have covered till now. In investment management, we are talking about two particular components, that is security analysis and portfolio management. Under security analysis, we have talked about risk and return. We have talked about the valuation of bonds and valuation of equity shares. We have talked about fundamental analysis and we have talked about the technical analysis. On the basis of this security analysis, individual persons try to collect the securities which they are interested in and form a mix of instruments. And this mix is termed as portfolio. So, under this portfolio, what we have to do? Which particular securities are relating with each other, we have to identify, and what we have to select the unrelated or uncorrelated securities so that we can have a less portfolio risk. Every security, whether it is a equity, whether it is a bond, whether debentures or derivatives, or we talk about FDs and RDs, every instrument has certain amount of inherent risk. In case of equity, it is quite high, but in case of fixed income security, it is quite low. But every security has certain amount of risk and return. So, on the basis of risk return analysis, we have identified or we have calculated the average return and we have calculated the standard deviation of the individual security. Now, under portfolio management, what we have to do? We have to manage it according to the expectation of the investor. While selecting individual securities, we are focusing that our expected return should match with that individual security. But while forming a particular portfolio or constructing a particular portfolio, we need to see that the overall portfolio risk should be minimized by whether the individual security has high risk, but overall portfolio risk should be minimized and it is going to give us a better return. So, with this objective in mind, the investment management concept is divided into two concepts, that is security analysis, where individual securities are analyzed on the basis of risk and return, and then whenever the particular person or investor is good enough to understand that this particular security is going to give me better returns and this is less risky for me, they are going to construct a portfolio with this. So, the portfolio is basically the basket of securities, where variety of securities depending upon my risk attitudes. What we have talked about? We have talked about there is a risk aversive person, risk neutral person, or risk moderate person, or risk taker person. So, on the basis of my risk tolerance, I am going to form my portfolio. That portfolio might consist of equity and debt instrument. This proportion should vary from type of investor or his risk tolerance level. So, whatever is the risk tolerance level of an investor, he accordingly invests. In case of risk aversives, he must have a debt portfolio. In case of risk neutral, the mix is 50-50. In case of risk taker, the proportion might go up to 100% of equity, or it ranges from 80% equity, 20% debt, or 90% to 10%, and it may ranges from 70 to 30 depending upon his requirement. So, how this particular concept has developed? The concept of diversification basically. Why we need to do this? Before the introduction of the Markowitz portfolio theory, individual persons are already diversifying their portfolio, but they don't know any mathematical calculation upon which the diversification has to be done. So they simply know that we have to diversify portfolio, we have to include bonds and equity shares in our portfolio, but they don't know the formalized way of diversification. So Henry Markowitz tried to formalize the concept of diversification, and Markowitz portfolio theory is totally based upon the concept of diversification. So it is the first theory that came into existence in the finance theory, which talk about portfolios. Before that, all the theories are either related to corporate finance or it is related to market and talking about individual security. But this particular theory is basically based upon the portfolio, how it should be diversified so that the portfolio risk is minimized and portfolio return is maximized by the investor. So now come to the background. In pre-1950s, because the Markowitz portfolio theory came into existence in 1952, it is propounded by Henry Markowitz. He got Nobel Prize in 1990s along with two other scholars who worked in the domain of financial economics. William Sharpe got this particular prize, a Nobel Prize in 1990s along with Henry Markowitz for the theory capital asset pricing model, and Merton Miller got the Nobel Prize for corporate finance theory. So these three people got Nobel Prize in the domain of financial economics in 1990s for their different theories they have propounded in different eras. So this particular theory came into existence in 1952. So before that, what is the way of forming a portfolio or how the individual people are investing in the stock market or any other financial instrument? First, the focus is on individual securities. So what the individual person is to do or the investor has to do, they basically focus on individual security, or they might have a portfolio of individual security only. Either they are investing in bonds and or particular equities, because that particular point of time bonds and equity shares are quite popular. Other financial instruments are available, but they are not so popular. Most prominent instrument during 1950s and before that is equity shares and bonds. So investors primarily focuses on analyzing individual securities like stocks and bonds in isolation. They are calculating the risk and return similarly that way we have calculated in valuation of bond and valuation of equity. But they are simply doing it in isolation. They are not combining it and try to identify what is the impact of combining these two securities in the portfolio. So the investment decision process centered around the potential of capital appreciation, dividend yields and the bond interest payment. That is the major objective, whether our capital is increasing, whether we are getting dividends regularly or whether we are getting interest payments regularly or not. That is the major objective of investment. Second component is security selection over portfolio construction. So individual, as we already mentioned, that individuals are interested in identifying securities that is related to stocks or bonds, and they are focusing on evaluation of individual securities. They are not combining the effect and try to get what is the portfolio return or portfolio risk. They are focusing on just that particular thing, that what is the risk of share and what is the risk of bond. So selection is based upon individual evaluation. Heuristic based decision. Heuristic based decisions, like there are certain rule of thumbs that are propounded or that are quite popular at that point of time. Still it is quite popular. In case of amateur investors, they used to follow these rules of thumb. The first is buy low and sell high. So what we have to do, if the equity price is going down, it's time to purchase the stock, and if the equity price is going high, then it's time to sell the stock. Don't put all your eggs in one basket. This is a common framework that we should not put all our money in a particular security. We should put our money in different securities so that we can hedge against the risk or mitigate the risk quotient. Invest in what you know. So these are the certain things which are quite popular at that point of time. So if I know a particular security, suppose I know ACC Cement or TCS, I know about these companies, then I am going to invest in these companies. I don't know about Suzlon, so I am not going to invest in that particular company. But there are companies which are small in size and they are giving better returns. Another thing that is quite popular is that point of time is value investing, which is popularized by Benjamin Graham in 1930s, which focuses on these approaches that we should invest in stocks which are either valued, that means they have a good intrinsic value. On the basis of calculation of intrinsic value, we have to calculate the overvalued or undervalued stock, and on the basis of that we have to select a particular instrument. Another measure that is quite popular during that time is PE ratio. So these particular things are quite popular at that particular time, and on the basis of that, experienced investors, or we can say the learned investor, used to do the investment. Next thing is limited understanding of risks. People don't know how to calculate risk. They just know that if there is a variability in return, that is actually the risk. But how to calculate risk, it is not quite popular at that point of time. Then diversification. Diversification, or the word diversification, is not quantified at that point of time. People know diversification because I have just mentioned the proverb that don't put all your eggs in a one basket. So people know that thing, that we need to invest in different securities. But what is the formal concept of diversification? It is introduced by Henry Markowitz. Along with that, he said that diversification should be formally quantified. So I have given certain measurement tools on the basis of which we need to diversify our portfolio. Then reliance on fundamental analysis. People don't know about technical analysis that much, and only the experienced investor used to go for technical analysis, and it is quite new concept at that point of time. So people basically go for fundamental analysis, looking into the economic condition, looking into the industry condition and company condition. On the basis of that, they are doing their investments. So limited access to data and research rule, that is also very important. At that point of time, recently we have all types of data availability. We can download the data, we can check the charts, all the things are available. There are expert opinion available. But at that point of time, the data availability is quite a major issue, and because of that, people rely on the information whatever they are getting, and on the basis of that, they do their investments. Next, influence of Great Depression and World War II. This situation has affected the psychological conditions of the investor badly. So because of Great Depression, the people started investment cautiously, because that has affected the economic condition, and it has basically make the investors more risk aversive. Or during, or we can say the after Great Depression, the concept of risk aversion is quite popularized. Before that, people used to be risk takers. They are investing in equity predominantly, but after the situation of Great Depression, they started investment in a much more better approach, and they become more risk aversive. The economic uncertainty and volatility of 1930s and 40s have reinforced a preference for government bonds and blue chip stocks and other conservative instruments. And after the World War II, further contribution of risk-aversive behavior is prominent because of the geopolitical issues and economic conditions of the countries. It becomes more worse. Lack of structured investment frameworks. People don't have any theory related to investments. So they are using whatever sayings are going into the market, and accordingly they are investing. So there are no comprehensive theory on the basis of which the decisions has been taken. So people used to follow the sayings of others and tips given by the brokers or the experienced investors, and they are investing. So this is the basic scenario of investment during 1950s, or we can say predominantly before 1950s. This situation is actually analyzed by Markowitz in his research paper called Portfolio Selection, which is published in Journal of Finance and which got him the Nobel Prize in 1990s. In this particular theory, he propounded that there should be certain qualitative as well as quantitative judgments for evaluation of securities and formation or construction of portfolio. Just on the personal judgment and qualitative factors, we cannot form a portfolio. There should be some quantification of portfolio construction, and that particular concept was evaluated or propounded by a Henry Markowitz in his theory, Markowitz portfolio theory, which is also known as modern portfolio theory. So Henry Markowitz, then a graduate student at University of Chicago, introduced a new quantitative approach to investment decision making in his paper Portfolio Selection, which has already mentioned, that published in Journal of Finance. And under this, he proposed that portfolios should be selected based on their expected return and risk rather than focusing solely on individual asset returns. Before that, what is happening? We are focusing on the individual returns because people are not aware of the standard deviation or expected return concept or calculation of historical return concept also. So people are just focusing on the returns. What is the return? They simply prepare certain trend lines, and on the basis of that, they are purchasing the individual security. But he propounded that we should focus on expected return and risk of individual security along with the portfolio risk and return. The center plank of the theory is that diversification through portfolio formation can reduce the risk, and return is a function of expected risk. So this is the basic concept that is propounded by Henry Markowitz, that what we have to do, we have to diversify the portfolio, and this diversification is going to reduce the risk, and return is basically the result or function of expected risk. So Henry Markowitz is also known as the father of modern portfolio theory. According to him, investors are mainly concerned with two properties of an asset, that is risk and return. So till now we have understand this thing, that whenever we are talking about investment, we are focusing on two concepts, that is risk return trade-off. The essence of this theory is that risk of an individual asset hardly matters to an investor. What really matters is the contribution it makes to the investors' overall risk. So if we talk about that share is quite risky and bond is less risky, still when we include these two in our portfolio, what is the risk proportion? That is the basic thing investor is concerned about. He is not bothering about what is the risk of share, what is the risk of bond. He is focusing on the combining effect of these two securities in his portfolio and how it is affecting the risk appetite of the investor. By turning his principle into a useful technique for selecting the right portfolio from a range of different assets, he developed the mean variance analysis, which is this theory is also termed as mean variance theory. So when we talk about mean variance analysis or mean variance portfolio analysis, we are talking about Markowitz portfolio theory. So what are the assumptions of this theory? The first assumption is investors are rational. This means the objective of investor is to maximize their utility. In other words, with a given level of income or wealth, their main aim is to highest possible return. The concept of rationality is also introduced with the help of this particular theory. They assume that investors are rational, and when we are talking about rationality, we want to maximize our utility from whatever investment we are doing. Second assumption is investors have complete information of risk and return of the asset. It means there is a free access to fair and correct information on the returns and risk of the securities. So all the information are available and we can evaluate the individual risk and return profile of a particular security. The markets work in an efficient manner that respond to changes in the information quickly and perfectly. So whatever information is available in the market, whether it is related to economy, industry or company, everything is reflected on the stock prices, and because it absorbs all type of information. The risk attitude of investor is that they prefer minimum risk and maximum return. That means the investors are risk aversive by nature. The decision of investors is based on expected returns and variance of return from the mean. So what we are doing, we are calculating the mean variance relationship, and on the basis of that we are selecting the securities in the portfolio. For a given level of risk, investors choose the portfolio which provides higher return. Hence, return preferences are monotonic. Return is a basic concept on the basis of which we are going to select a portfolio. Suppose there are combination, and on the basis of combination 5-6 portfolios has been formed by the investor. Then he has to select which portfolio is giving his maximum return, and that portfolio will be selected by the investor. Now, coming to the concept of diversification. Diversification, the fundamental concept of portfolio management, because when we are talking about portfolio, we are talking about different types of securities, and when we are talking about different types of securities, that means we need a diversified portfolio. Aiming to reduce risk by investing in variety of, the major aim of diversification is that we want to reduce the risk. It is a central element of Markowitz portfolio theory, where it is quantified and optimized, because Markowitz has calculated all the things, and on the basis of his calculation he said that if we have a proper portfolio, it is going to give us maximum return and minimum risk. Portfolio is a combination of securities such as bonds, shares and other financial instruments. The process of blending together the broad classes so as to obtain the optimum return with minimum risk is called the portfolio construction. Now, what is the principles of diversification? The diversification involves spreading investment across multiple assets. These assets may be of different financial instrument, it may be related to different geographies, it may be related to different sectors also. We can diversify our portfolio based upon asset classes, based upon sectors and based upon geographies, so that we can minimize our risk. The idea is that not all assets respond the same way to the economic events, meaning that negative performance of one asset may be offset by the positive performance of another asset. This is the basic reason why we want to diversify our portfolio. The next goal is to reduce the unsystematic risk, which we already discussed about. It is a unique risk that is related to a particular sector or particular company. So, we can diversify it easily. So, it becomes very important. If we diversify, we can reduce this unsystematic risk. Now, what is superfluous diversification? Research studies have shown that optimum benefit of diversification is obtained when an investor spreads his investment across a certain number of securities, suppose 10 to 15 securities, but it should not spread his wealth in too many securities. If he invested in 10 to 15 securities, there are chances that this particular diversification may prove unfruitful for the investor, and he may loses his money from this unrelated diversification. So, spreading one's wealth over too many assets is referred to as a superfluous diversification. What are the problems related to this diversification? Poor performance, because we have a good bunch of 10 to 15 or more than 15 securities in our portfolio. We are not able to manage the portfolio easily and not able to check each and individual security time to time, and it may cause problem for the investor. Second, information inadequacy. There are chances that lack of information is available to the investor regarding a particular security, and it may cause certain problem to the investor. High research cost. If he wants to get all sort of information about a particular security, in that case he may be a certain amount of additional cost related to that security. Then high transaction cost. Having 10 to 20 securities in a portfolio, it becomes a lengthy transaction for the investor, because he has to bear lots of transaction cost on individual securities. Now, types of diversification which are already talked upon. Asset classes means we can invest in shares, bonds, derivatives, financial derivatives as well as commodity derivatives, then cryptocurrencies. So, there are lot many asset classes. Real estate is there, then mutual fund is there. So, lot many asset classes are there, that means the financial instruments are available. So, we can invest in these types of financial instrument according to our risk tolerance level. Then sector and industry, so the variety of sectors are available in the particular stock exchange, you can look into it. So there are real estate, there are pharmaceutical companies, there are companies related to IT, telecommunication, so lot many industries are available. So you, according to your need and requirement, you can diversify the portfolio. Then geographies, we can invest in our country as well as we can go in foreign countries and purchase the shares in foreign countries. In that case, that is geographical diversification. Currency diversification, you can invest in your country shares as well as you can go for foreign country shares where the denomination is changed. Then time horizon, you can go for short term and long term duration investment as well as medium term investment depending upon your need and requirement as well as your objective. So we can have the short and long duration. So depending upon your requirement, you can go for any type of diversification that you required at a particular point of time. Now coming to limitations of Markowitz theory. The first, that the portfolio returns are not normally distributed but are heavily skewed on the tails. So I have already explained you about the normal distribution curve. This is a simple normal distribution curve. You can look into any of the statistics book and check what is a normal distribution curve. But in general, we have a skewed that may be like this or it may be like this way, it is skewed and it may be a problematic situation for the investor. Investors are irrational as they are suggested, or Markowitz has suggested that investors are not rational, but in real life situation, investors are either normal or irrational because of their risk taking behavior. They make sudden decisions which may prove wrong for their investment. In reality, investors in the market have limited access to borrowing and lending of money at risk-free rate. This is suggested by Markowitz that it is easily available, but in reality, it is not easily available. We have to bear a certain amount of interest on this particular thing. In reality, investors have different information and forecast which leads to varying estimate of expected returns, risk and correlations. So when we are talking about expected returns, we are talking about the probabilities associated with. So depending upon my knowledge, my expertise, I may assign different probabilities and you may assign different probabilities. So that is a situation where the decision may vary. MPT assumes a static investment environment while real world is quite dynamic and everything is quite changing. So the theory output is highly sensitive to inputs like expected returns, covariance estimate, and which in reality is very difficult to estimate. Because when we go to the formulas and estimation of Markowitz portfolio theory, we will look into the fact that in real life situation, it becomes very difficult for investor to calculate these things. But in the basis of the theory, it has propounded, but real life situation, it is very difficult. Only the fund managers have the ability to go for the application of Markowitz portfolio theory. Normal investors like you and me, it becomes very difficult to go for portfolio analysis with the help of covariances and correlation calculation that has been propounded by Markowitz. So there are certain disadvantages of the theory which make it more unreliable or unrealistic in real life situation. So with this, we come to the end of this particular topic. Thank you.